This
I see
conference
my
will
shirt
now be
anymore.
recorded.
Red Sox, yeah. I'm gonna blur that out. Hey, everybody. Welcome to Peter and I's weekly recap. This is Trader Travis. That's my Success Academy co-trainer, Peter, over here playing with his camera. I'm blurring it out. He's trying to show his... we're copyright, buddy. I don't even know if we just show stuff like that.
I don't see why not.
Yeah. So we are going to get started here. For those who are new, hey, we just do these every week to talk about the stock market, kind of share what we are up to as active investors or passively active. I'm kind of a buy and hold investor who happens to trade options or trade options in a buy and hold way. Everything we're sharing is for informational and educational purposes only. We're not giving you investment advice, just showing what we do. Now, with that being said, what I'm going to do today is show you my screen real quick. And I'm going to continue my theme that I've been talking about in the Success Academy. It finally dawned on me. Lately, the theme I've been teaching people is how to insure your 401k, 403b, or TSP investment accounts, those traditional retirement accounts. A lot of people are unaware that you can buy insurance for those, stock market insurance, and that protects you against a massive loss. Like when I first started sharing this concept, literally people looked at me, one of two responses. It was, well, three actually. It was either they looked at me like I was an alien, from another planet. They either flat out didn't believe me, like, whatever, you're a scammer. I was like, and then the third is people were like leaning forward. I was like, really? Well, how did you do that? And that's the group I like. So then I explained it to them. And then it dawned on me, I was like, you know what? Other people may have this issue also. So let me go ahead and teach them how I did it for my own mom. And that's why I've never taught this. I've never had to teach it. Like my strategies, I have built-in insurance. I have a strategy called the Family Freedom Fund. I only buy stocks during market crashes. So when the market crashes, I don't freak out. I don't have any exposure. And then people are like, well, the market's been going up for 10 years. Aren't you losing money? No, because I generally buy a call option, and that allows me to capture the market movement. Literally, I'll get the same buy and hold return, but I have like 5% of my account out in the market. So 95% is sitting in cash. So I get the market return. Most of my money is sitting safely in cash. When the market crashes, I don't freak out. I've built an insurance. I've never had to buy a stock market insurance policy for that portfolio. Then I have another smaller portfolio. It's active option trading where, 90% of my money is in cash, and I'm doing the high risk strategies. Those are the strategies you saw me place in this recap. So let's look at one of them, QQQ. I'm in that right now. You've watched me place that trade. It shows I'm down $5,000, right? Well, those shorter term trades are more risky in nature. And so I generally, don't risk a lot of my money on those. So, maybe 1 to 2% and put numbers behind it. If I have a 10 grand account, I might lose $100 or $200. I'm not going to cry. I'm not going to lose any sleep. So I've never had to teach this insurance concept, but I'm glad I'm teaching it now. You're going to hear more about it in the coming weeks. Let me actually make sure I don't run over here on my time because I don't want anybody to lose more than 5% of their account during the next market crash. That is possible if you insure your portfolio. So let me move forward real quick. One other thing, not everyone needs insurance. Peter and I was just talking about this before we hit record. Not everyone needs insurance, and I will save that for another recap maybe next week. So you can see if you're someone who even needs to get insurance for your portfolio. Like someone like me, who I've talked about earlier, what I just said, my two portfolios, I don't need insurance. It has built-in insurance the way I've structured my stock market investments. So I want to give 2 examples here why you probably should consider getting insurance. Here's an example of 2 investors. I call them John and Henry. Henry's on the left. John is on the right. Now, John didn't have stock market insurance, and he went to the market crash. He lost 55% of his account. Normal. That happened in the 2007, 2009 crash. So this shows you, what their portfolios look like after the crash. Because Henry, he had insurance. He only lost 4% of his account, and that's how much the insurance costs, 4% of his money. So Henry has $96,000. He earns 7% a year. John has $45,000. He's earned 7% a year. Why 7%? That's the average that buy and hold investors will earn. You're going to earn the same return. This just shows you what it looks like for someone who lost money and someone who didn't lose money. So you can see here that Henry took a year just to get back to break even. That's because of what we call the secret investing loss formula. When you lose money in your account, you need more to get back to break even. Well, Henry didn't lose a whole lot. So he really didn't need to earn a whole lot to get back to break even. John, on the other hand, because he lost so much money, it took him 12 years to get back to break even. You can map this out yourself. The numbers don't lie. This is how it works out, except that buy and hold investors never discover this because you're adding money to your account, right? Your dollar cost averaging, you're hiding this, that dollar cost averaging, you see your account going up. It's because you're financing your own growth. If you never add anything else to it, you let the numbers play out. This is how it play out. It would take you 12 years to recoup that loss, right? But here's the scary part. You never catch up with Henry. Here's what it looks like after 30 years. 30 years, Henry has $730,000 in his account. John only has $342,000. This right here, this John example, is precisely why people get to retirement and they don't have what they need. This, when you see this number, people are like, well, that's close to what I have in my retirement account. I've been investing 30 years. This is why. Because some loss you suffered along the way, you never recovered from it. No one taught you to insure your portfolio, so you can end up like Henry. You can see here, Henry is far richer. This is Buffett's secret to getting rich faster than everyone else. His 2 rules about don't lose money. This shows you that if you just don't lose money or you lose less than everyone else, you will get richer than everyone else. Henry is richer than John, not because he earned more, right? He earned the same return as John. He's richer because he lost less than John. You can map this out yourself. This is reality. Okay. Now, that's the next point. A lot of people are like, well, if I earn a higher return, well, I'll catch up with Henry, right? Yeah, we earn the same returns, but what if I trade options? I make more. Nah, not true. Here's an example. Here's how it works out. Okay, Henry only lost 4%. John lost 55%. John is now going to earn 15%. Henry is going to earn his measly 7 still. You think you can catch up quicker? How long does it take? It still takes 11 years for John to catch up with Henry. Right? It's not the 30-year example I just showed you, but it just shows you that he's earning more than double as Henry, and it still took 11 years. So this proves that it's not about earning more, because even if you earn more, you're still set back 11 years before you catch up with the guy who didn't lose money. So the summary here is it's not about earning more. It's about following Buffett's rules of not losing money. Now, next point, some people are going to come back and be like, well, Travis, I looked this up. This concept of buying insurance is called a protective put option. I've looked it up. They're expensive. You know, it's going to cost me 4% of my portfolio a year on average, give or take. You know, if you buy a 2-year policy, it's going to cost 8%. And they're like, if I buy that insurance, I'm going to be set back financially, because let's look at the last market. Market's been going up for 10 years. If I bought an insurance policy every year for 4%, I'm going to earn less than everyone else is going to set me back financially. That's also false. And then I'm going to save that for next week's example because I don't want to take this over too long. What I want to do is just in full transparency here, I'm going to show you some of my losing trades here. We're looking at the market. I was going to cover the general market. The general market, actually, let me cover this because Peter and I were talking about it. The general market has had these pullbacks in 2017. People forget this. People have short memories. The market pulled back in 2017 twice. Right? It's doing the same thing now. If we zoom into a 9-month chart, we can see we're in another pullback or slight market correction here, and it's kind of just meandering along, right? It can't stay here forever. It's either going to go down or go up. Honestly, we don't care. We're kind of straddled the market. If it goes up, great. We'll make money like everyone else. If it goes down, great. For those who have insurance in their portfolio, they're going to make money or be okay. For those who trade low risk option strategies like we teach, they're not going to lose that much. Then they're just going to sit in cash waiting for the market to sort itself out. But I'm going to show you these trades right here. QQQ, I already showed you I'm losing money on that. MVD is another one. Now, when I say I'm losing money, it's on paper. It shows a loss right now, but it's like buy and hold. Yeah, you may go through periods where your account shows a loss, but as long as you don't close out that trade, you don't book the loss. And these trades still have some time to play out. So I may actually have to take a loss. I may not. That's the downfall of options. You have a ticking time clock before, your trades. Buy and hold stocks you can hold forever. Options you can't. They have a time limit. And that's what some people consider them risky, is because you don't have forever for the stock to work out. If it does work out, let me show you my profit here. I have all the trades I profile on this weekly recap right here. So QQQ, you can show so far, I've had to close some trades for a loss, shows $12,000. But the income I brought in for NVDA was $12,000. Lows, I brought in $11,000. You watched me place all of those on these recaps. So in total, so far, I'm still standing at a $16,000 profit that I brought in, even despite the paper losses my account shows. Now, if I have to book some of those losses, yes, this 16 grand will go down a little more, but I will wait for all of these to play out, and then I will drop you in and see what the final results are. And then after that, we will move on to a new case study, because again, I think moving forward, I'm going to really hammer in this insurance concept, because my goal is for everybody under the influence of Peter and I's voice, our mentorship, for you all to not suffer during the market crash, to lose no more than 5%. I want people writing about us like, hey, these are some people who understood Buffett strategies. I'm not speaking on my own authority. I'm speaking on Buffett's. He's already taught us the secret to getting rich quick. I just don't think people paid attention to it. So with that being said, let me turn the floor over to Peter. Peter, are you ready, my friend?
I am. I just want to pull up my stopwatch. Okay.
Yeah, I lost track of my time. I don't even know how long I went.
And you know what? I'm going to kind of piggyback off of one thing real quick, so you guys, you can see my screen here.
Yeah, I can.
Okay. Okay, so I'm going to focus you in on NVDA. So you guys, if you've been watching our recaps, I went from doing weekly cash secured puts on NVDA to a long-term, what we call the Buffett strategy. So you can see I sold a 235 put, which has 144 days, but it's actually in the money because NVDA is at 230. And then I bought a 350 call. I kind of messed up those calls because I bought them too far out of the money, but that's okay. Basically, those calls were paid for by the revenue from these puts. So if NVDA comes back over the next 144 days, if it starts going higher and it gets up to those, past that 350, I'll make money off of those calls, and I'll keep whatever premium that paid for. So anyway, but I want to focus you in here. When I was doing those weeklies, I bought protection when I did them, and I have one contract at 255. So if I'm assigned here at 235, I only have to buy protection for 2 contracts, right? Because I already have one at 255. Now imagine that if I get assigned at 235, I could turn around and sell 100 of those shares at 255. So, and then look at my protection is 100 days longer than those cash secured puts. So that's what Travis is talking about. So I just wanted to piggyback off of that real quick, Travis. So that was real quick showing you what protection can do for you when you do apply it. I don't apply it in every one of my trades, and that's something we'll go over at another time. If I get assigned on AT&T, because right now I have AT&T shares in real money out, it's a cash secured put. It's looking like it's going to expire worthless, but we'll see. However, this is a vertical credit spread I have open right now on McDonald's. I think, let's see, I can't see it because that's in the way. Yeah, it's at a 12% loss right now because, you know, everything's going down. But my win, this is a bear call, and that's at a 54% gain. So if win keeps doing what it's doing and time keeps ticking away, probably by next week, even though this has 25 days, I'll probably be able to buy that back and keep 80% of the credit it gave me, which is good, because if I lose 50% on McDonald's, which is my exit strategy, I'll still have a gain. So that's on that account. And then over here on my margin account, you can see I have my Macy's trades here. These are most likely, these are all covered calls. These 2 here are covered calls. These are most likely going to expire either worthless or I'll buy them back at probably an 80% gain. My QQQ, I'm most likely going to buy back and rinse and repeat here. I got to do some calculations. I'll cover that next week. And my AT&Ts are looking like they may expire worthless. Those are, again, are covered calls. I do not have protection on this AT&T here. And Travis and I were just talking about it. Why don't I have protection? I'm on the fence with protection. I'm biased towards AT&T. He asked me that. He said, "Are you biased?" I said, "Absolutely, I'm biased towards AT&T, but I'm not biased based off of myths. I'm biased based off of the research I've done on AT&T, and I track this stock all the time. And as a matter of fact, I am an actual shareholder of AT&T, and that's the other thing I'm going to start listening to is the shareholder call meetings, because you get a good idea of where the stock is going. So I understand at any given time, although AT&T is one of my long-term holds, I may have to dump it. So I already have a backup stock in the wind if AT&T decides to change things and change their dividend or whatever the case is. My other short-term account, I have a Macy's covered call opened, and I got to look at it today and see where it's at. If it's at an 80% gain, I'll turn around and buy it back and rinse and repeat that one. And then I have AT&T shares. I'm gonna wait until I'm cleared out of my paper trades, and then I'm going to just stick. I have a lot of real accounts that I trade on too, and that's what I'm going to start trading on majority of the time. I won't do paper anymore. So that's basically where I'm at. Look at that, 4 minutes, 25 seconds.
Boom, drop the mic. And I just turned off my camera too, like, oh, let me give him some time.
Oh, I never turn off my camera.
Oh, no, you don't have to. I just do it because I'm always fiddling around. I'm what do my wife call it? Fidgety. I'm always doing stuff. Yeah. Drinking my, look, Peter's laughing at me. I didn't want y'all to see this on the camera. Like, oh, I'm chugging my gallon of water over here. Like, yeah, that'd be distracting. That's why I'm turning my camera off. So anyway, I think that's it. So we're going to keep these short this week. Hey, Peter said something and I never thought about it. We lost money in 2016. He was like, I'm glad it happened to you too. He's like, because he said, one, your calmness helped me be calm and I didn't freak out. And I was like, yeah, I never thought about that. Like I was explaining to Sex Academy rooms, you never see me freak out. It's like, this is why. I mean, a lot of this stuff is normal. The market doesn't just go up and go down. That's why I keep telling people it has a zigzag motion. It doesn't just rocket higher. We always want it to. And then times like this, you watch how we handle it, both emotionally and strategically. Are we still placing trades? Are we kind of sitting it out, waiting it out? Why are we calm? And that's why I'm tackling this insurance concept and how you can structure your portfolio so you don't hurt yourself financially when the market has these normal corrections. So with that, I will end it here. You all take care, and we will see you in next week's recap. Bye-bye.
Go Red Sox.
Oh, God. Edit that burp out. I was holding it. I was like, oh, gosh, can I say bye without burping it out? Oh, let me go ahead and stop the recording.